Welcome back. It's another edition of The Real Money Show. My name is Jeremy Wiseman. The number 1-866-274-9570 or 1-8778-SILVER. With me today, Jerry Correia. How you doing, Jerry?
Feeling good, Jeremy. How you doing?
I hope you're feeling good. I saw you have a double espresso, which I'm just about to dig into myself.
Oh, yeah.
It's The Real Money Show, and we're so happy to be back on the air this week. We've got so much to talk about. The key is we have an inflation alert, a big inflation alert. And, of course, the Fed says it's transitory. I don't know where they're coming up with that exactly, but they say it's transitory. So let's dig right in. Actually, before we do get to that, let's talk about the numbers this week. We're very excited. Today, we're recording on Thursday, May 6th, as you're listening over the weekend. But we have gold up $30 to $1,815 an ounce. Silver is up just over 90 cents today, trading at spot price of $27.37 US per ounce. This is the jump we've been waiting for, isn't it?
We're definitely seeing the swings that is needed to start breaking out and shaking out some of the shorts. We're seeing 3% moves almost every other day, kind of reminiscent to other markets, but definitely, we're excited. Finally, gold has finally reclaimed above the 1800 mark, a huge psychological level. 1850 is the top side support, anywhere around 1822 to 1850. And ultimately, overall, gold is bouncing off of the 61% retracement from its highs back in August of last summer. It's a healthy retracement. All of that is being digested, of course. The 10-year Treasury yield. Yeah, a few months ago, it was heading higher every day. But the last month, the U.S. 10-year Treasury yield is down and negative for the month. So that has reversed. So we're anticipating higher highs for precious metals.
We're going to talk more about the inflation. We're also going to talk about interest rates, the low interest rates, what that's doing to the market. Let's dig in on the inflation side of things. This is, to me, very important. It's something that is now just blatantly obvious to everybody. I just pulled this off of tradingeconomics.com. This isn't even the year over year on these commodities that I'm about to tell you about. This is just year to date, okay? Crude oil is up 33%. I'm just going to cherry pick some here, okay?
Yeah, please share.
I saw a good one. Let's go into lumber's up 91%. That's just year to date, not year over year. Milk, 9.74%. Tea, 5.8%. Rice is up 7.44%. There's a lot of people around the world eating rice. Coffee, 17.86%. Your daily brew, as we drink our espressos, Jerry, that's going to be 17% more expensive. Sugar, gotta love those sugary cereals and all that beautiful chocolate.
How sweet it is.
Not so sweet when it's 16% more expensive. Beef up 12%. So I guess we have to stop eating beef, right? What are we going to eat instead of beef? I guess it would be soy. Let's see what we can find. Soy is up there. Poultry up 18%. This is absolutely crazy. Corn, 56%. So all of that junk food, right? With corn oil in it and all of that stuff. 56% on corn. Palladium just hit an all-time high, though. $3,000. Right. That was very exciting. But you know what is lagging? Soybeans, by the way, I did find it on the list here. Soybeans, 22%. So explain that one to me. We're not going to eat beef anymore, right, as the Biden administration's saying. It's up 12%, right? All the energy on it. But soybeans are up to almost 23%. So, yeah.
Doesn't make sense, but it does.
Silver up about 4%. I think we're probably up a little higher based on today.
Yeah.
But lagging. Both gold and silver are lagging. Do you think that is basically just because of what we experienced last year with the massive moves in the market? Or would you just say clearly manipulated, don't touch the market?
Well, the bullion banks have to unwind on many of their shorts. Both gold and silver futures markets are in this. Their short positions are still in the market. We know JP Morgan's out there net long. But they're buying time. This is sort of the canary in the coal mine when you see all this, the base metals and commodity sectors all moving higher, all because of the one thing that we are hearing a lot about. Last weekend, billionaire Warren Buffett of Berkshire Hathaway warned at his company shareholder meeting last week that we are seeing very substantial inflation. This is coming from Warren Buffett, out of all people, warning his investors to, be wary about what's happening, what's coming down the pipe, which is a massive inflation. So gold and silver, we know historically they are negatively correlated to the U.S. dollar and have a positive coefficient with inflation. So we're anticipating some great moves in precious metals.
The number 18778 silver and the website guildhallwealth.com. Before we go forward, Jerry, just want to give a shout out to John B., longtime client of ours. Spoke with him today. So just want to speak to him. Had a great, lovely chat. Let's get back to this inflation because it's something that everyone is seeing. No one is there. There isn't anyone who can't see it. Everyone going grocery shopping. It's interesting because before the Biden administration took over and we were talking about this, it was really only food that people were seeing. It was, food's up there. Food, we go grocery shopping, but now it's everything. Mm-hmm. Now it's absolutely everywhere and everything. And the funny thing is how can that not be related to all of the money printing that's going on?
Well, it certainly is. And a famous economist, Milton Friedman, famously noted, inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. It is all because of the expansion of N1 money supply, the expansion of risk and debt-related assets, anything that has benefited from cheap credit, money printing. You're blowing bubbles everywhere. Everywhere we turn, north, south, east, west, we have bubbles all across the world. And it's, leaving investors high and dry looking for yield, when in fact it's really all about, it should be at least, protecting and hedging against what is coming. Position against inflation, but position as well in an asset undervalued like gold and silver that will ride this thing right up.
But why, Jerry? Why not just stay in the real estate market, stick with your stocks? Why should I be worried about these things imploding when the Fed has everybody's back? When the Fed sits there and says, we have your back, we promise you we have your back. Like it's as if all investors have Stockholm syndrome. They're just like, I love my captor. He says he's going to take care of me at the Fed, that they will backstop any of our investments. So why should I leave the basement? Why should I turn away and walk out of the cave? Why not just stick with what we're doing? It's working.
No, well, people are not. You and I both know people are leaving the status quo, that people are leaving what they once had in their portfolios. The stock, bond, cash approach, which year over year loses over time. And Ray Dalio even famously said, if you don't own gold, you do not know history. And our investors like to look into history, like to see what has happened in the past with paper currencies having a finite life value. The Canadian dollar, what is it backed by? Nothing. It is totally fiat, which is Latin, which means let it be so. Well, not for Canadians. Our clients are waking up. They're coming to know better, and they're not believing. I mean, we're in an era where there's very little trust anywhere. We are in a trustless society, and when we are in this type of society, you got to clamor, you got to run to where you find trust. And for monetary purposes, it's always been gold.
Well, I definitely trust that the Fed is going to continue to say that this inflation is transitory. They would be falling from a building and say everything is perfectly fine. Speaking of history, Jerry, this was an interesting post from Gold Telegraph on Instagram, which I had to save. It said there are 11,000 cryptocurrencies.
Wow.
There are 180 fiat currencies. There are 118 elements. One element has been used as money throughout history. Gold. Few understand this. Well, one person who understands this is billionaire Ray Dalio. Another is Sam Zell.
Yeah, Sam Zell, actually a billionaire. He was reported by bnnbloomberg.ca. Billionaire Sam Zell, the headline goes, buys gold for the first time in bet on tight supply. So amazing headline, but it actually rung a bell, didn't it, Jeremy?
Yes, it was. It struck me as odd because we did a video 2 years ago where Sam Zell said, and it was on Bloomberg, that he just started to get into the gold market for the first time because of everything that we talk about on this show.
That was 2 years ago?
That was 2 years ago.
But then this headline here from BNN Bloomberg says this was his first time buying gold. So,
well,
where's the trust?
The trust. Listen, I trust that the Fed is going to continue to say that inflation is transitory, but it's not. The number 18778 silver, the website guildhallwealth.com. If you want to have physical, hold in your hand precious metals, you want to contact Guildhall Wealth. We'll show you how to do it. We'll even show you how to hold physical metal in your RSP, TFSA, LIF, RIF, or even your RESP. And it's all about direct ownership of the physical product. The website, guildhallwealth.com. This is The Real Money Show on Global News Radio, 640 Toronto. We'll be right back. Welcome back to The Real Money Show. The number 18778 silver, the website, guildhallwealth.com. We've been talking about billionaires jumping into the gold market. Nothing new for them, even though BNN reports that it's new. Sam Zell, he is a real estate mogul in New York and around the world, and he is getting into gold. They're saying for the first time, but he's been doing it for over 2 years. So, maybe they're just making him look good. I don't know, for timing's sake. Ray Dalio, he owns gold in his portfolio. I wonder if Janet Yellen has gold in her portfolio. What do you think?
Well, the former Fed chief, who is now the Treasury Secretary of the United States, definitely feels that she has a dual role, continuous in this market, in this economy, in the world. And she spoke last week, and she tried to quell the worries about inflation and that the market's going to be strengthening, and that interest rates will have to rise somewhat, she says, to make sure our economy does not overheat. Her comments...
Oh, that is Fed speak right there.
That's total double speak, that's right. Her comments spooked the market and led to a global sell-off. But then later on in the afternoon, she had to back off on her words, which helped to calm the markets. Gold then flipped on the top side, and the 10-year Treasury yield. So it was a very ugly move. And, really, do we take her words as bond? Really, no. The market has totally shrugged off her comments on inflation and a likely rate hike, as the market seems to believe that the Fed is unlikely to embark upon any tightening or tapering anytime soon.
But maybe she's saying it, maybe she, intentionally or not. The Fed will be forced to act. It's not going to be just, they're they can do whatever they want. They will be forced. They're always reactive. Mm-hmm. They're never proactive with these things. And then they jawbone as if they are proactive, right? They're like teachers who lose control over the class before 4 o'clock and everyone's leaving. They say, okay, let's go early, right? I think she could be doing the same thing, basically saying, look, we know we're going to have to raise rates. There's no issue. There's no choice here, mm-hmm. right? But that's not what the markets want to hear. The party is going strong. No one wants to hear that this party is going to end, unless you have your eyes open and say they can't keep printing money forever without consequence. We see the consequence everywhere in terms of price inflation. It's no joke. It's mm-hmm. real. The problem is who's it really affecting? Who are the winners? Who are the losers? Just things like the fact that they're printing what? They're going to create $4 trillion, $6 trillion worth of packages in the States. They don't even need it. They want to get back to work. But yet, let's figure out a way to give people more money so they don't have to actually go out and earn a living. And then you've got people who are running businesses who can't get workers, because why would you get workers? They're sitting at home getting free money from the government, eating pizza and investing in cryptos and mm-hmm, GameStop. Mm-hmm. No offense to any of those guys. We want you guys to all make a ton of money. But it's a drag on the economy, isn't it?
It totally is. Huge drag on the economy. And further, Money Metals Exchange, Stephen Gleason actually commented on this topic of transitory. Is it temporary, or is it the beginning of a long-term trend? And we know that they are totally reactionary, the U.S. Federal Reserve. They will do nothing to quell off something before it hits the fan. The Fed has claimed it has tools to keep inflation well anchored. Should something rise and inflation rise, it becomes a bigger problem. But does it have the will to inflict financial pain on Wall Street, the big banks, and the U.S. government, knowing that the U.S. Fed is addicted to ultra low interest rates? They have no other arsenal in the toolbox besides raising interest rates, and we know what that's going to do to the stock market.
And they printed so much money. When you look at the balance sheet and you say, when they started in 2008 in that crisis, the balance sheet was under $1 trillion. They pumped it up to over $4 billion. Then they tried to pay it down, right? They didn't get they couldn't raise interest rates, and that was after quantitative easing 1, 2, 3.
Mm-hmm.
You know, that was, and obviously gold went crazy in 2011. So did silver, 2010, 2011. Then in 2020, the Fed, well, we know in 2019 they couldn't pay it down. They had to reverse course. They started upping the balance sheet again. And then in 2020, they went to just shy of $8 trillion. They've doubled it over again. They've actually put more money in 1 year than they did over a course of 3 years with quantitative easing. And we're supposed to act as though it's all good? We were primed for that. Anyone who opens their eyes and goes on and sees that chart, it's not the only chart out there. I mean, look at Canada. They've printed more money in the last 4 years than the entire history of Canada.
It's insane.
It is insane. It is insane. Jerry, stop the madness. How do we stop the madness?
Well, we know, Jeremy. We've been talking to people about this every day. Buy gold and silver. That's really the only way.
Was that your tip talk?
That's right. But this narrative of transitory, it makes me laugh, really. And Stephen Gleason, he just concludes, is this transitory? Is it temporary? This inflation that we're seeing? Yes, the CPI, we know the numbers in the CPI, we can question all day long. But the problem with the narrative that the Fed is peddling on inflation is that the U.S. fiscal and monetary policy are still going full blast with emergency spending and stimulus. There is no let up in sight. So this is not transitory. And similar, what is not transitory is the loss of purchasing power versus gold and silver. Every single major currency is down 12% on average versus gold and silver. We have a global problem with fiat currencies. The money printing will not let up, which is the reason why a lot of nations' central banks have decided to go long on physical bullion, long on gold, hold it in the central banks, acquire. And surprising to see some of the countries that have started to really ramp up their gold supplies. Portugal, some of the Kazakhstan, Turkey, of course, Hungary. So we commend all of these nations for doing, we believe, what is right for the nation.
Well, it's interesting. The countries that end up doing are the countries with the knowledge of history, and it's probably happened in their countries where they say, never again, right? It won't happen again. I have a tough time really looking at this transitory comments. I know we're really sticking with that today, but just because it's so glaringly false when you see crude oil up 33% this year. We talked about soybeans being up 22%, milk being up almost 10%. You've got corn up 35%, beef up 12%, poultry up 18%. You guys all know this because you guys all go to the grocery store or get your Uber Eats and you see the prices rising. Copper 31%. This is just unbelievable stuff. You can't tell me that this is transitory when it's across the board on all commodities. And I'm telling you, I'm trying to look for something that's down. Manganese is down. Okay. All right. That's tea, only 1%. Rubber is down 2% this year. Okay, good for you guys. Like
everything else.
Come on, uranium.
That's
all right, it's
list.
down 0.5%. You know, so I just look at that and I say, gold, silver, they've been doing their job. Okay, have some patience. It's going to continue much higher. We love seeing what we saw this week, where gold gets over that $1,800 an ounce line. we knew it was going to happen. We knew it was going to be this kind of, okay, they pulled it back under 1,700, $20 a week. It's starting to move, kind of cusped that 1775 mark, and you just knew it was just really, really close that it's there. You know, once you hit 1775, the psychology was we're there. It's going to go over 18, and it did. And now it's going to be really interesting to see how it ends the year. We're not quite even on gold for the year, which I think is a present. I think it is a gift. When you can see all of the inflation everywhere else, and gold and silver have been held back for you, you know they're held back because of the premiums on the product. It's time to get in. You know, it's time to look at your portfolio and say, how do I hedge now? How do I take some profit off this? Do I really want to believe that this market can continue the insanity that we're seeing, and that inflation is somehow going to be stopped? You know, they're gonna put that fire out. I just don't see it happening. I think we're at a point where it is a repeat of the 70s. The stagflation is going to happen again. And what happened last time is they ended up putting on price controls. So if you're a business, they're going to tell you can't raise your prices anymore. What are you going to do? You're just going to close shop. You're going to go home and eat pizza and start buying cryptocurrency on whatever money you can borrow from the government. It starts to feel like it's all a plan.
And these businesses are at a point where they have to start thinking of raising wages. When you have universal basic income feeding the employees their checks, there's no incentive to go back to work. So how do the businesses stay open? How do they keep staff? Well, like you brought up 1970s. That was the last time a wage price spiral started to happen. So we're seeing this around Toronto. We went to the city the other day, and you know, Yorkville looked really, really unnerving. I haven't been downtown for a while, but Jeremy, what are you seeing downtown? And you frequent there a lot.
I mean, the retail's been devastated. There's no doubt about it. Retail has absolutely been devastated. Who knows which restaurants are gonna end up surviving, or what it's gonna take for them to fully get back on their feet. I really do believe once those restaurants do start opening, you know, I don't see how they're going to avoid charging extra. You know, like a table fee, a bread fee. You know, the tips on the machine are just going to creep up higher. You know, all of these type of things. But retail's really bad, and yet real estate's going through the roof. And there's people out there making tons and tons of money. And the thing is it's the middle class that are really being destroyed here. And that's why we're here talking about this, because at the end of the day, we know gold has hedged against inflation. It hasn't even gotten started yet. When you compare the amount of debt out there, $300 trillion plus, not including unfunded liabilities, not including, you know, all the leverage in the market, $10 trillion in gold, that's nothing. That's nothing. We are at the very, very beginning of this. We'd like to see people get in early before the market really, really takes off. And that's why I think we have a gift right now. And what we offer here at Guildhall is physical product. We're not offering the promise of counterparty risk. We're telling you, you will have direct ownership of the product and actually physically hold it in your hand, whether you want to take it home, buy it and take it home, whether you want to store it in an independent vault facility outside the banking system, where you have access to the product at all times, or store it in a registered account. And that could be your RSP, your TFSA, your retirement income fund, or RIF, your LIRA, all of these things. You can actually own the physical precious metal. You get an inventory report, shows you exactly what you're holding, specifically what you have direct holding of. People can even take delivery of. You know, we're okay with that. If someone wants to test the system and pay their 30% withholding tax and take it home, yeah, go ahead. I mean, you can do it. If it's a TFSA and you've decided, you know what, I really would prefer if it's in my hand, you can absolutely do it. We can handle that, especially with RIFs. I find every year when people are taking their payment, a lot of our clients are saying, instead of taking home $10,000, $15,000, let me take home my physical gold because I'm not ready to sell it yet. Right. And I love that. And maybe they hold on to it. Maybe they're looking for generational wealth. But it is an asset. It is money. besides cash, I can't think of anything you can just remove from an RSP.
Yeah, it's great to have that option in the RIF. You can either take the cash position of that gold, or you can take the physical home, which is great. Even specify which bar number you want to take home. That's going to be yours, and that is earmarked and owned by you. I'm seeing that as well. A lot of Canadians who have RIFs, they may have income properties or income coming in, and they may not need the cash. But yeah, generational wealth is sort of their focus at these golden years.
And one of the issues with pensions is the low interest rates.
Yeah.
Low interest rates are having an incredibly negative impact on pension plans. And we see a lot of people moving over their pension plans for just this reason. And we're going to explain how gold is going to fix that issue for you in the next segment. The number 18778-SILVER, the website guildhallwealth.com. This is The Real Money Show on Global News Radio, 640 Toronto. We'll be right back. Welcome back to The Real Money Show, the number 18778-SILVER and the website guildhallwealth.com. Jerry, one thing I want to quickly talk about is the impact of low interest rates. While Janet Yellen may be either jawboning or threatening that interest rates will eventually climb, which is something the market needs, I think it would be happening at the absolute wrong time, which I wouldn't put past the Fed at the end of the day. I think they've completely missed their opportunity to try to turn the boat around. So they obviously don't want to turn the boat around. But let's talk about the impact of low interest rates. One of the things that you get with the low interest rates is that when it comes to taking your money out of your pension, out of a RIF, for retirement planning purposes, is that you're taking out your capital. Mm-hmm. You can't possibly live off interest alone anymore. Or now you have to take the risk of going into stocks, right? They always ask you at the bank, or they used to ask you at the bank, what's your threshold for tolerance for risk? Well, given your age, we want to go with non-risky things. So let's put it, there's nothing there. Mm-mm. You can't put your money into you could not put your money into a GIC these days.
No.
I mean, come on.
And this brings us to a good look at what's going on around the world. There's a headline from the Wall Street Journal this week. Negative rates push cautious Germans into the stock market. It's just a really short, sharp story about a gentleman, Michael, 70 years old. He's a saver. He's got about $300,000 in a local bank, totally risk averse. But now the fact is that they have gone negative interest rates in Germany, charging negative 0.5%. And what this has done, it's caused him, a risk-averse person, to get into the stock market at frothy levels. The overall stock market is overvalued. I'm not too certain as to how the price to earnings are in the U.S. or in Germany, but certainly overvalued. Not something that he wants to do, but he's being forced to chase the yield and chase the risk. So. Not his strategy, but he has no choice.
Yeah, chasing yield is it. It's you have no choice but to join the party, right? So here you are, valuations are completely crazy. The other thing is also, you have on the one end, you have the older population. On the other end, you have the younger population and generation where they can't form capital. They need savings as much as seniors need the savings. They need to be able to put their money away and understand that you can put your money away, save it responsibly being the operative word here, mm-hmm. and creating wealth for yourself, whether that's, saving money to build a business, saving money for a down payment. How can you save money for a down payment in a low interest environment when the housing market's in a complete bubble because of low interest rates? People are borrowing so much money, mm-hmm. which leads me to the next point, which is the only people that are really benefiting from it, of course, are the rich, who can borrow at the lower price and buy up crazy amounts of assets. And now you get into the misallocation of funds where they're buying up, whether they're just throwing money at businesses that who knows if that business is going to be around. They don't care. They're just looking for somewhere to put the money, mm-hmm. right? They can take advantage of it, but they can also lose. The stock market could come down, the leverage can come down, housing can come down, and it could all come down as a crashing cards. But in the meantime, you've got this misallocation of funds, right? So that's the other issue. The rich get richer, the poor get poorer. Seniors have to end up with no interest rates, so they have to take from their capital, which means they're living on less at a time where inflation's starting to happen. So they're living on even less. Mm-hmm. It's absolutely terrible. And what I've noticed and been observing over the last 15 years in the gold market is gold has completely hedged all of these issues. And anyone who has held gold for the last decade or even 5 years can sleep well at night. They don't have to take the risks that other people are taking. And then finally, the other note is that you get into this scenario with young people as well, where they don't know what it's like to save money at all. I mean, at least I can sort of remember higher interest rates, 6%, 7%, 8%. You'd put your money in the bank, you'd save money, right? And then throughout my entire life, it's just been going lower and lower and lower. But now they get into the you only live once. You might as well do it because you don't have any other choice. You have no choice but to play roulette with your savings. Why should people have to play roulette with their savings?
You can't. This is a total reprogramming of the mind to think you only live once. Do what you can now. Don't necessarily own or save anything. Rent everything, Uber everything, rent a bike, rent a vehicle. The lack of ownership. Well, you can't have generational wealth, and you cannot maintain your name, your legacy, without ownership of assets, hard assets. Gold, silver, natural fancy color diamonds, land. These are assets that are necessary for every individual. Look, we're not the Wall Street guys. We're not the ultra rich. We're not those people who we talk about, the rich getting richer. The target is on us. Every single individual listening to this show. The target is on your portfolio, your legacy. And Canadians especially are waking up, and it's very refreshing to come in and hearing the whys of why people are getting into this market. What is that? And usually a question, I'm not sure if you're getting the same questions. Jeremy, there's so many variables out there. It's bubble territory. There's so much debt, the derivatives, Archegos, the hedge fudge that went bust. I'm keenly watching that because it was something that was interesting with regards to their derivatives exposure, leverage in the market. How many more hedge funds are leveraged like this gentleman had this hedge fund? It's a systemic thing that can ripple, and we need to understand or identify where is that proverbial needle that's going to prick the bubble and cause that systemic crisis. Are you getting that same question?
I do. I think everyone senses there's a powder keg. They don't know where it's going to come from. On my side, what I find is that a lot of people are contacting us, and they're sort of relieved to understand that we share their opinions. They're like, we want to be conservative for a change, and we're being poo-pooed on every step of the way. And somehow, as well, I feel like gold has become a conservative vehicle. It's like, I don't know why that is. I mean, everyone should have it in their portfolio, and those that feel that they're safe just by investing in stocks without any sort of hedge, I really do think they're going to have a wake-up call. But look, at the end of the day, gold's averaged 11%. There's a lot more money out there that's been made. That's amazing. That's not the point. This is about protecting your wealth, and it's done that, and it's beat inflation, and that's the key. I do think as well that we're just at the beginning. These markets have incredible opportunity ahead of them. Gold could easily get to $10,000. Silver could easily get to $300-400. And when it does get there, it's going to look normal. It's going to look absolutely normal. I do want to talk about the Fed in the next segment because they are not as in control as everybody thinks. The number 1-877-8-SILVER, the website guildhallwealth.com. It's all about physical assets, gold, silver, and we're going to talk some natural fancy colored diamonds here on The Real Money Show. You're listening to Global News Radio, 640 Toronto. Welcome back to The Real Money Show. The number 1-877-8-SILVER, the website guildhallwealth.com. We're talking about physical gold, physical silver. I do want to talk about natural fancy colored diamonds. But first, let's talk about the Fed. They are not always right. And in a panic, Jerry, I want to go back to 2008 because they did not save everybody, and they did not save every bank. There were banks that went under, and I will just name one, Bear Stearns. And you can't sit there and say that every bank is too big to fail when they let them go, right? For whatever reason, you can just sit there and say, I think people have to really question, will the Fed have everybody's back? And how do they have everyone's back when they've already gone from under $1 trillion to $4 trillion to $8 trillion? Where are we going to be 6 months from now, 7 months from now? I mean, again, how much money can actually be printed before they turn around in a crisis and go, we can't do anything. Now, let's talk about panic for a second. Let's really talk about panic. I've seen panic. We've all seen panic now with the pandemic.
Yeah.
Okay. And there are a couple different reactions to panic. One is nothing. People just become a deer in headlights. No decisions to be made. The market's crashing.
Head in the sand.
They put their head in the sand. They don't want to deal with it.
Don't want to log into their bank account.
Yeah, and the bankers don't want to call their clients.
Right.
And they don't want to look at their book, right? And they just go silent, radio silent. And you know what they do? They send their, if you can hear this, that's a letter of resignation from advisors to their bosses. That's what happens in a panic, right? I don't want to be a part of that. You need to take responsibility for yourself.
Sure.
That's what this comes down to. And when you know that you have direct ownership of that product, even if it's in a vault, as long as you know you can go and touch it, that's safety. That tells you I don't have to worry about panic. I do not have to worry about panic.
Yeah.
But speaking of that, also, if you're storing it, if you're self-storing your product, we don't have a problem with that. But you should, when you're considering a portfolio, think about, well, in a panic when everyone is selling, do I have something I can easily sell? Do I have a position in the vault that I can pick up the phone and sell?
Yeah.
I think that's something that's prudent. Definitely having your own holdings at home, whatever, that's fine. But I think you also, down the road, when silver is trading at $135, $200 an ounce, you want to be able to pick up the phone and say, sell a few hundred ounces.
That's right. And that is one of the topics of conversation that we must have with every one of our clients, knowing that the silver to gold ratio is about 66 to 1 right now. At what point do you want to sell your silver? Because we have strategies that we can offer. Again, we're not advisors, but we will tell you what history has shown. And that's what this market is all about. What has history shown? And this is what's so exciting. It's been 13 years since 2008, and nothing really has changed besides the amount of debt that has been poured on. Due to the fact that '08 was a debt issue, a credit crisis, nothing has changed. So knowing that this market is cyclical, it just tells us, hang on to your precious metals, buy more precious metals, at least 2,000 ounces of silver if you can do that, because in 1980, 2,000 ounces could buy you a house or pay off your mortgage. We want to provide you with the means to do that, and one of those is through silver ownership. And no, look, we're not here to sound the alarm or ring the bells and be this naysayer. No, we want to be rational, and one of those ways is just look at history. And once you understand that this could potentially happen, where are you on the scale? Scale of 10 being total gray sky, that the sky is falling, Armageddon tomorrow, I need 100% precious metals. Don't laugh, we have clients that are 100% precious metals. And then maybe 1, you're total blue sky, but still you need at least a little bit of precious metals. So it doesn't matter where you are, blue sky or gray sky, that's amazing. We're somewhere right in the middle because we have precious metals. Where are you in that scale? Get in contact with us. We want to find out where you are in that threshold and how we can help. We're here to help.
The number 18778-SILVER, the website guildhallwealth.com. And just before we jump into diamonds, Jerry, we've got a few minutes left. I want to talk about something kind of interesting on my mind a little bit. Cryptocurrencies. One of the things that people will say about cryptocurrencies is that there's a finite amount. Right, and that's what makes it special, as the fact that, well, there's only a certain amount of Bitcoin out there, and that's it. There's a limit to it. But one of the things that I'm trying to figure out in my mind, and please, listeners, make comments or get in touch with us, is the fact that you can buy it in the smallest of increments, 0.000000. So it's always available. So in some ways it's like, there's a limited amount of one full coins, but I can buy it in the smallest of increments possible, and it's always available, which, for better or worse, that's something to consider. Now, let's just look at gold for a moment. And this is really just sort of a cautionary tale for someone who's going to wait on to buy gold until the price goes through the roof. If gold were trading at $31,000 an ounce, and there's 31 grams an ounce, the smallest increment would be 1 gram.
Right.
Which would be $1,000. That would be the smallest amount of gold that you could buy, would be a 1 gram bar or coin worth $1,000. Of course, Pamp Swiss and Royal Canadian Mint don't sit there and say, you know what we should produce the most of?
Right.
Grams.
Quite the opposite.
Quite the opposite. So you're going to have a tough time finding those. There's going to be a massive premium. So where does this go? You have to think about the actual physical real world of tight supply, right? That's just a small aside. Take that for what it is. Leaving on a note about natural fancy colored diamonds. Argyle mine is closed. Those diamonds went up 500% while the diamond mine was open. And we're heading into an inflationary period.
There we go.
What do you think is going to happen to the colored diamond market?
Well, history has shown that the colored diamond markets perform during high inflationary cycles. So this is one place where you want to secure your wealth in a luxury asset, as we like to say, an asset that is not only a smart, prudent asset that is continuously going up in value year over year, but that it's extremely beautiful and rare, something that we as in hard assets love to offer a client to make a portfolio of hard assets, a little bit of gold, a little bit of silver, and add a natural fancy color diamond.
The number 18778-SILVER, the website guildhallwealth.com. Thank you so much for joining us this week and joining the discussion on inflation and physical assets like gold and silver. Feel free to touch base with us. We'd love to talk to you more about the gold and silver market and how we can help you own some physical gold and silver in your portfolio. Again, the number 18778-SILVER, the website guildhallwealth.com. You've been listening to The Real Money Show on Global News Radio, 640 Toronto. We'll talk to you next week.